most markets have been trading lower in the past 5-6 weeks, and there's continued negative sentiment, which is stemming from the Eurozone, not only impacting Eastern Europe, but equity markets around the world. On a more fundamental level, the links between Eastern Europe and the Eurozone are there, but they're very different. It's primarily the Central European countries, like the Czech Republic, Hungary, Slovakia, that are dependent on the Eurozone in terms of trade, with lots of exports to the Eurozone, and also in terms of foreign direct investment. We've seen massive amounts of FDI going from Germany, Italy, Holland into places like the Czech Republic, Hungary, and Slovakia. So of course, if you're having a bearish outlook on the Eurozone, this may primarily have a negative impact on Central Europe, even though I think growth will still be stronger there. Other countries, such as Russia and Turkey, further east, and also with larger domestic economies, are less dependent on the Eurozone for their economic model. Russia primarily exports commodities to the rest of the world, and Turkey is actually the least export-dependent economy in Europe, and the exports they do have tend to go to a diverse set of regions: Middle East, North Africa, Central Asia, Russia, but also to Turkey, but not nearly as much. Russia is our top bet because we think that the fundamentals are very strong. The Russian market is currently trading at a price-earnings ratio of 6, which is the lowest of any major market in the world. The earnings growth is expected to be around 37%, which is also among the highest in the world. So we are bullish on Russian fundamentals, and once this Eurozone-related sentiment is being reduced, then I think the Russian market can perform quite strongly, and I would, from now, expect the market to at least be able to perform in double digits. But of course, the longer the Eurozone negative sentiment lasts, the shorter the time for the rest of the year for performance. But on a fundamental level, that is very strong. Similarly, but less extreme on Turkey. The Turkish fundamentals are very supportive. The market is slightly more expensive than Russia, but still cheaper than most other emerging markets and most other Eastern European markets. Then there is a range of smaller markets in the region that are trading at fairly interesting multiples. But they are more frontier markets, and the economic recovery is also less strong than in Russia and Turkey. So it may take longer for investors to return to these markets, like Serbia, Romania, Croatia, that we find very interesting from a valuation point of view at this point. But of course, these are not included in the main indices, so it may also take longer for investors to return. So there, I think the upside is quite big, but it will take longer before the money returns there.